opportunity for you to ask questions after the management commentary concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shripal Doshi. Thank you, and over to you, sir.
Thank you, Yusuf. Good afternoon, everyone. I welcome you all to the earnings conference call of Power Finance Corporation to discuss the Q4FY23 performance of the company, industry trends, and business updates. We have the senior management team of PFC with us, represented by Mr. Ravindra Singh, who is the Chairman and Managing Director, Ms. Parminder Chopra, who is Director Finance, and Mr. Manoj Sharma, who is Director Commercial. I would now like to hand over the call to Mr. Ravindra for his opening comments, after which we can take question and answer. Over to you, sir.
Thank you very much. A very good afternoon, everyone. I welcome you all to this conference call. It has been more than a year since we last connected, and I am delighted to have the opportunity to update you on the performance of Power Finance Corporation for the fourth quarter and financial year ending March 2023. The last year has been a year of revival for both the Indian economy and PFC. As we step into 2023, the economic environment appears even more promising than anticipated, and I believe it will continue to drive capex growth in the power sector. The key highlights for the financial year 2023. Now let's start with the key highlights of the performance of PFC. Standalone performance. In financial year 23, PFC delivered the highest ever annual profit of rupees 11,600, marking 16% increase from financial year 22. Even in quarter 3 2023, PFC recorded the highest quarterly profit of rupees 3,490, representing a notable 34% jump from the previous year. It brings me great joy to share that PFC has been consistently breaking its own profit records for the past 2 to 3 years. At PFC, we have always emphasized on maximizing returns for our shareholders. With the final dividend of rupees 4.5 per share announced on Saturday, the total dividend for FY23 reaches 13.25 per share, representing 132.5% dividend per share. With this, PFC continues with its trend of delivering extraordinary shareholder returns. On the dividend front, I want to address the queries often received from retail investors on when the final dividend payment will be made. I would like to inform that the dividend recommended by the PFC board will be approved by the annual general meeting, following which the dividend will be paid to the shareholders. Now let's move to some key financial indicators. The yield for FY23 stands at 10.04 versus 10.22% in FY22. This is lower compared to the previous year but remains within our targeted range. This dip can be attributed to interest rate cuts implemented over the past 2 to 3 years. The cost of funds for FY23 saw a 20 basis points increase, resulting in cost of 7.51% compared to 7.30% in FY22. This rise is mainly due to increase in market rates on account of RBI policy tightening. Driven by yield and cost of funds movement, the spread for FY23 is at 2.53% and NIM is at 3.36%, both within our guidance range. The CAR remains healthy with a CAR of 24.37% and Tier 1 capital of 21.61% as of 31st March 2023. These levels give us sufficient flexibility to our borrowers, particularly the government sector, where PFC is now subject to RBI limits. Moving on to the consolidated performance. PFC Group delivered a strong performance in FY23. The group's loan asset book crossed rupees 8 lakh crore mark, reinforcing PFC's position as the largest group in the Indian power sector space. Furthermore, the consolidated PAT for FY23 reached a new high of rupees 21,180 crores, reflecting a 13% increase from FY22. Now turning to PFC's loan asset side, I am happy to announce that we have achieved a substantial increase in disbursement for the fiscal year 2023. We disbursed a remarkable amount of rupees 85,760 crores, representing a 67% increase compared to the disbursements of 51,240 crores in the previous financial year. It is worth noting that COVID-19 pandemic had a dampening effect on our loan asset growth over the past 2 years. However, I am pleased to share that we are witnessing a revival of economic activity post-pandemic, which coupled with the lending to distribution sector and government schemes has been instrumental in driving the uptick in our loan asset growth. Our standalone loan book has demonstrated strong growth with a double-digit increase of 13%. As of March 31st, 2023, our loan book stands at an impressive rupees 4,22,500 compared to 3,73,000 crores as on 31st March 2022. As we look ahead, we maintain an optimistic outlook for the growth of our loan asset book. Building upon the positive momentum we have witnessed this year, we anticipate the loan book to grow at a similar pace in the coming years. Coming on to the asset quality, I am pleased to share that our continuous and active resolution efforts over the past few years have yielded exceptional results in addressing non-performance assets. In the last 1 year itself, PFC has resolved 3 stressed assets amounting to rupees 4,400 crores. These assets include Southeast UP Power Transmission, Jhabua Power, and in Bharat Energy Utkal. As a result, our stressed asset book has decreased by 21% from 20,900 as on 31st March 22 to 16,500 as on 31st March 2023. Consistent resolution efforts have led to lowest net NPA ratio in the past 6 years. For FY23, our net NPA ratio stands at an impressive 1.07%, reflecting a significant decrease of 69 basis points from 7.76 in financial year 22. Furthermore, our gross NPA levels have also witnessed a substantial decline. In FY23, the gross NPA levels decreased significantly by 170 basis points from 5.61 in FY22 to 3.91% in FY23. Moving on to the update on resolution status. We currently have 22 stressed assets with a total value of rupees 16,500 in stage 3. Out of these 22 projects, 13 projects worth 13,900 crores are being resolved under NCLT, while the remaining 9 projects amounting to rupees 2,600 crores are being resolved outside NCLT framework. On the provisioning front, I would like to mention that successful resolution and upgradation of stage 3 assets during the year has contributed to provisioning reversals without any additional credit cost. It is crucial to note that although in absolute terms provisioning against stage 3 assets have reduced, but we have enhanced the overall provision coverage ratio on stage 3 assets from 69% in FY22 to 73% in FY23. We firmly believe that these provisioning levels are adequate to support future resolutions. Now I would like to provide an update on the liability side. In FY23, PFC raised a total amount of rupees 76,000 crores from both domestic and foreign sources. As of March 31, 2023, our outstanding borrowing stands at rupees 3,62,630 crores. Looking ahead to the next financial year, that is FY24, I would like to share that PFC board has approved a borrowing program of rupees 80,000 crores. This program aims to raise funds from both domestic and international markets through various instruments including bonds, term loans, commercial paper, and other suitable avenues. On the domestic currency front, I would like to highlight that our low-cost 54 EC portfolio, which has a coupon rate of 5%, witnessed a remarkable 65% increase in FY23 compared to FY22. As of March 31, 2023, our outstanding 54 EC bonds amount to rupees 6,600 crores, a substantial growth from rupees 4,000 crores as of 31st March 2022. Turning to our foreign currency side, we have successfully raised US dollars equivalent 1.66 billion in foreign currency during the year. In line with our objective of diversifying our borrowing, these funds were raised in USD and Japanese yen, and through combination of products such as foreign currency term loans, FCNBB loans, and loans from development banks. While borrowing in the foreign currency exposes us to exchange risk, I want to assure you that we have been consistently monitoring our forex positions to mitigate this risk. Currently, our exchange risk hedge ratio stands at approximately 68%, a significant improvement from 55% last year. Moreover, we have hedged 92% of the exchange risk for portfolios with a residual maturity of up to 5 years, including 100% of exchange risk for US dollar loans with a residual maturity of up to 5 years. With these measures in place, we firmly believe that PFC's bottom line is adequately protected from foreign exchange fluctuations. Before I close, I would like to share our strategy for the coming year. First and foremost, our business priorities will be closely aligned with the targets and thrust areas set by Government of India, especially in the energy transition as well as DISCOM reforms. On the generation side, in line with government's energy transition goals, PFC would continue to tap renewable energy business. On this front, I would like to share that PFC recently undertook one of the largest financing deals in renewable energy space, within which we have refinanced JSW Energy loan of rupees 6,112 crores for renewable energy projects of Mitra Group, which has been recently acquired by them. You know, right now, India's energy transition landscape is quite exciting, with newer technologies being explored to reduce carbon emission. Some of the emerging technologies that are now being explored for commercial expansion are green hydrogen, battery storage, pump storage, and offshore wind. PFC thrust in coming years is to actively target these technologies and contribute in making India a greener nation. On this, I would like to further add that while going green is undoubtedly the way forward, but energy security is also crucial. Recent events such as energy crisis faced by European countries during the Ukraine-Russia war have highlighted the need for additional conventional generation capacity to ensure grid stability and meet the ever-growing electricity demand. Therefore, while renewable energy will be a focus, conventional generation funding will continue to be a part of our lending business, although not at the same scale as in the past. Also, government is looking at reducing carbon emissions from the existing coal plants by retrofitting them with carbon offsetting technologies. We see that this is another potential lending opportunity for PFC in future. Moving on to the distribution sector, it is currently one of the top priorities for the government, as it plays a critical role in improving the overall health of the power sector. To improve the operational and financial health of DISCOMs, government has launched the revamped distribution sector scheme in 2021 and late payment surcharge scheme in 2022. PFC and its subsidiary REC are the nodal agency for RDSS implementation, and all eligible states and UTs have been allocated between PFC and REC equally. RDSS has an outlay of rupees 3 lakh crore covering smart metering and infrastructure projects, of which around 60% will be from government grants, and the balance will be the counterpart funding from PFC or REC or states' own resources for infrastructure works. The smart metering shall be implemented in PPP mode. Before the counterpart funding starts, the action plan submitted by state DISCOMs were to be approved, and the government grant portion is to be released based on the achievements of the milestone. I would like to share the action plan approval process is complete for nearly all eligible states of PFC. Further sanction is being awarded by DISCOMs and the grant release cycle has started. Around rupees 1,679 crores of grant has been released so far. With the progress we have made, we expect counterpart disbursements under RDSS to commence towards the end of FY24. Also in this context, I would like to highlight that the scheme is playing an important role in bringing financial discipline in the state DISCOMs by the way of regular publication of quarterly accounts, timely submission of annual accounts, timely release of subsidy and payment of government dues, tariff orders, etc., which are some of the important qualification conditions for release of funds under the scheme. Coming on to the NPS scheme, the NPS scheme was introduced in around June 2022, which has shown promising results. With a 40% reduction in outstanding dues of DISCOM to GENCOs within just 10 to 11 months, PFC and its subsidiary REC are the key financiers for the schemes. So far, PFC has sanctioned around 47,900 crores, of which 35% has been disbursed, that is around 16,700 crores. The remaining balance is expected to be disbursed in the course of next 1 to 2 years. On the distribution side, RDSS and LPS are the two schemes where we envisage major business opportunities. Now turning to the recently added business line for PFC, which is infrastructure funding. This is one of those milestone decisions which will play a crucial role in PFC's long-term business growth. Diversifying to infrastructure lending was a natural extension given PFC's past experience of financing electromechanical components of infrastructure projects. The idea is not to shift focus from power to infra, but to gradually build it over, creating a separate business line as the power sector matures. But yes, it will be forming part of our future lending business going forward. Since receiving approval in August 2022, PFC has already sanctioned around 16,650 crores and disbursed around 1,000 crores. These funds have been directed towards projects such as ports, irrigation, and fiber net. Additionally, it is important to highlight that we have initially focused on specific sectors within the infrastructure domain. We remain open to funding all types of infrastructure projects. We understand the significance of diversifying our portfolio and expanding our capabilities. Therefore, we are actively working on building our expertise and strengthening our team to effectively cater to diverse needs of the infrastructure sector. In this direction, on 26 May 2023, we have entered into an MOU with RITES for providing technical assistance and support in financing of infrastructure projects. Lastly, I would like to share some promising figures that demonstrate the potential growth for PFC. Currently, we have approximately rupees 2,31,600 crores of sanction in our pipeline, which we plan to disperse over the next few years. Moreover, we have entered into memorandums of understanding worth rupees 90,000 crores with various state agencies in the fiscal year 2022-23. These strategic agreements are aimed at extending financial assistance across the power sector value chain. Notably, we have signed significant MOUs with predominant states like Andhra Pradesh, Uttar Pradesh, and Madhya Pradesh, as well as with Kerala Infrastructure Investment Fund Board and Mahatma Phule Renewable Energy and Infrastructure Technology Limited, MAPREIT. These collaborations will not only support the power sector but also contribute to the growth and development of infrastructure as a whole. It is important to emphasize that the project sanctioned under these MOUs will span several years, providing a valuable and sustainable business pipeline for Power Finance Corporation. In conclusion, we remain optimistic about our future growth. By leveraging favorable market conditions and maintaining our commitment to prudent lending practices, we expect to continue growing at a similar pace as we have witnessed this year. Thank you very much, and now we are open to the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Dhaval from DSP. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. Congrats on good performance. I had two questions. First is relating to the spreads and margin. So, sir, this year we saw a decent reduction in spreads from 2.9 to 2.5%. Going forward, where do you think spreads will stabilize? Given the rise in cost of fund that we are seeing right now. So any comments here would be useful, both on the repricing as well as cost of fund side. So that is the first question. Then I have one more question.
So you are going to add with the second question, or should I reply to the first one?
Sir, you can reply, then I'll ask the second one.
Okay, fine. So, as has been indicated, our spread has decreased, and basically our interest rates, we had implemented the decrease in the interest rates, and then there was an increase which we had done of around 165 to 300 basis points we had decreased, and then we had increased the interest rates in December 22 and March 22. So that effect of increase is yet to materialize, and on the borrowing side, the interest rates have increased. So our spreads have decreased, as you had indicated, by around 40 basis points. And going forward, we should be maintaining the spreads within our guided range.
Okay. So, sir, you're saying that this 2.5% spread is sustainable going forward with the repricing that you've taken in December and March. Is that correct?
So further also, we are reviewing our interest rates, and based on that, let us see if we have to increase, we'll go ahead.
Okay. And sir, what is the magnitude of price increase you've taken in December and March? Cumulatively, what price increase you have taken?
So in March, we had increased by around 10 to 50 basis points across different category of projects. And in March 23, it was 25 basis points across the board, except 10 for renewables.
Understood. Got it. Sir, my second question relates to asset quality. So you indicated the 16,500 crore stage 3 between NCLT and outside NCLT. I just wanted to understand within NCLT, the big accounts would be KSK, Mahanadi and Lanco Amarkantak. Would these two be the biggest part now?
Right.
What?
You are right.
Okay. And sir, any comments on both these projects? Where are we on the resolution front, and any possibility of either of them happening in FY24?
So KSK Mahanadi is under NCLT, and the consolidation of the different SPVs is under NCLAT. So that is the ongoing position as of now. And with respect to Lanco Amarkantak, a letter of intent was issued to PFC Projects and REC Consortium, and the resolution plan has been filed with NCLT. So we are waiting for the decision of NCLT.
Understood. Apart from that, sir, any other project under NCLT which is large and likely to see resolution in FY24?
So one of the projects is Sinnar Thermal, where the proceedings under NCLT have been stalled, but we are in discussion with Maharashtra Genco for taking over the project. So let us see what happens based on that discussion. And another project is East Coast, which is under liquidation. and Maheshwar Hydel project is there, which was admitted after a long period of more than 4 years. It was admitted under NCLT, but now again the CIRP process has been stayed, and we have filed before NCLAT for early hearing in this case.
Got it, sir. Those are the questions from my side. Thank you and all the best.
Thank you very much. Thank you.
Thank you. The next question is from the line of Arjun Bhatia from Bowhead Investment Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one clarification on your loan growth guidance. So you said loan growth in 24 to be similar to 23. So you mean loan growth should be around 13%, which is very ended Q4FY23.
So now we have started funding infrastructure. So let us see what type of projects we are getting. A lot of projects in infrastructure, but there is a restriction that we can only sanction around 1/3 of our total assets, the total sanctions during the year for infrastructure. So going forward, because the base for the last year was slightly lesser, so we have to see whether we will be able to maintain the same growth or not with respect to the percentage.
So any percentage number that you're targeting in 24? Say double 10, 11, 12, 13%, now could it be lower?
You're not very audible. Your voice is not clear.
Yeah, am I audible now?
Little bit better.
Yeah, no, I'm saying just loan growth for 24. So any range that you have, say between 10 to 12%, 12 to 13%?
So we should be around the double-digit mark.
Okay. And my next question was, any chance of PFC being made a nodal agency for financing renewable projects?
So we have taken up with the government of India for becoming a DFI for energy transition. So that was not accepted by the government. So we have been trying to get special dispensations from the government of India. And going forward, we were trying to become a focal agency for lending to renewables, energy transition.
Okay. So when you say focal agency, so is there like any formal process to that? Like, have you been applied to some authority for that?
No, we have not applied, but we are in discussions with the Ministry of Power and Ministry of Finance regarding that. And as you are aware, we have the largest loan book for renewable energy of around 48,000 crores.
Right. Yeah. And just on the infra segment, do you have any disbursement targets for FY24 or FY25?
So disbursements, we are getting the figures from our borrowers, and we think that we should be at the same level, almost the same level with the economy reviving and a lot of renewable projects coming up, and also transmission projects. And obviously, the funding to RDSS will also start, and where the counterpart funding from PFC and REC will also be required.
Got it. And just lastly, on this 2.3 lakh crore of sanctioned pipeline, which is very impressive that you said you have as of now. So how much of this can convert to, say, disbursements in FY24 and FY25?
Could you repeat that?
Out of the total sanction pipeline of 2.3 lakh crores that you gave, which is very impressive, how much of that can convert to disbursements in FY24 and in FY25?
So the implementation of the project will take around 2 to 3 years for implementation, And some of the recent projects we have funded are infrastructure projects which may take a longer time. So the disbursement will follow the implementation.
All right, got it. Thank you so much.
Thank you. Before we move to the next question, a reminder to the participant, anyone who wishes to ask a question may press star and one. Next question is from the line of Manish Agarwal from Phillip Capital. Please go ahead.
Yeah, hi. Good afternoon. A couple of questions from my side. One is on your infra sanctions. So if I look at REC, this year have sanctioned almost 85,000 crore, and we have done somewhere around 16,000 crore. So why so difference in the sanctions? Is that some of the projects we were not comfortable and hence we didn't entertain?
No, I think REC had sanctioned a major to that Mumbai Metro. So there they had executed the loan documents, and we have. It is not that we are adverse to funding these projects, but initially we have taken exposure to the refinery project and the other projects, ports also. We have done the disbursement also. We have done around 1,000 crores to the port.
So any particular reason why we are averse to metro funding? Is it because of tenure or high risk involved there?
No, we are inclined to funding metros. We are not adverse. We have received DPR for the metro project also, and we are going to fund these projects. There is no, we are not avoiding these projects.
Okay. My second question is on your interest reversal this quarter. I understand a large part of that is because of interest reversal in stage 1 and stage 2. So any particular reason why we are doing that, or is it because discom rating has improved and hence we are now reversing that?
So I would, our Director of Finance would take that question.
As you know, during the Q3, when we have announced the results, we said that there is a change in the discom rating, and as a result, around 900 to 1,000 crore additional provision was required to be made based on the annual rating exercise. So the rating exercise is carried out on half-yearly basis. So when we have done the next half-year basis, reviewed the rating, so the lot of discoms have complied with the conditionalities and submitted their accounts, based on which they have been upgraded, and major, as you rightly said, the major amount is on account of upgradation of the discoms.
Any further scope of interest reversal there?
Discom rating, as I told you, that it's a half-yearly exercise, and if there is further improvement in the overall functioning, compliance and financials of the discom, then definitely the same will be reviewed.
Got it. I have another question on Lanco Amberkantak. So there was some news that DPAM is not comfortable with the current structure of REC PFC bidding. Any comments on that? And when do you think is a feasible date for completion this resolution?
So we would like to clarify there is no regulatory hurdle in the PFC and REC bidding that bid for Lanco project, and the resolution process is going on. As I had indicated, that the resolution professional has filed the application with NCLT with our bid, which was accepted by the
Okay. And any time frame you would like to allot to this, or it's too early to take call?
We're just is a legal process which is there, so we will refrain from giving any timeline.
Sure. Thank you. Those were my questions. Thank you for answering those.
Thank you. The next question is from the line of Jigar Jani from B&K Securities. Please go ahead.
Yeah, hi. Thanks for taking my question. Two questions. Firstly, we have seen a sharp increase in renewable energy allocation within the generation segment. So just wanted to understand whether the margin profile for renewable generation projects is a bit lower than normal generation projects. If you could comment on that, because in the slide you have mentioned that the yields are lower for these kind of projects. So if there could be any commentary on that.
Renewable energy has always been our thrust area, and we have lower interest rates for these projects because Government of India is also targets out there that 500 gigawatt of renewable energy is to be there by 2030. So we have to support that, and obviously, as I had also indicated, we had done refinancing projects for JSW, and we are more than 6,100 crores was sanctioned, and out of that 3,400 has been disbursed. So these projects have a lower gestation period also, and they are implemented. So we take larger exposures to these projects also because financial closure is required by the developer early, and the processing is also faster for these projects.
Okay, understood. And sir, for this ECL exercise, I believe this is based on FY22 numbers, but the current numbers for the ACS ARR gap and the AT&C losses, if you look at the current numbers, they have gone up as compared to FY22 levels. So when you do the review next time, does that negatively impact the ECL model now?
So the numbers which you are talking about, there is the quarterly numbers will be there, the yearly number will be different for what we have seen earlier also. So we will go by the annual numbers.
Because I believe you said it's a half-yearly exercise, so just wanted to clarify that.
So whenever there is a change in any information which we receive from the in the accounts or some accounts are given to us, then only we change to the rating. Otherwise, it is a annual exercise which is we do on behalf of the Ministry of Power.
Sure, sir. Thank you. And just last question, is it possible to split the private sector loan book into like Genco and transmission and distribution, if possible? Percentage-wise,
private sector is around 20% of our total book, and we will provide you the details with respect to the generation, transmission, distribution. Distribution is hardly there is any exposure.
It's
a small one.
Okay, great. I'll take it offline probably. Thank you so much for answering my questions. Thank you.
Thank you. Before we move to the next question, reminder to the participant, anyone who wishes to ask a question may press star and 1. Next question is from the line of Mangesh Kulkarni from Almonds Global Securities. Please go ahead. Mr. Mangesh, your line is unmuted. Please go ahead with your question. Mr. Kulkarni, please go ahead with your question. As there is no response from the current questioner, we'll move to the next question from the line of Niharika from Equitas Investment. Please go ahead.
Hi, thank you for the opportunity. I just want to understand why have we increased our TCR from 69 to 73%? Is there increase in risk which we perceive or some change in the regulation?
Could you repeat that? We could not get.
So my question is on the PCR. So why have we increased our provision coverage from 69% to 73%? Do we perceive more risk increase, or is it some regulation because of that which we are doing this?
No, that is only majorly on one project, that is TRN Energy, where the provision has been increased. Even though in absolute numbers, if you have seen that our provisioning is overall on the basis of stage 3 is lower, but with the resolution of the asset and the lower NPAs, with the increase in the TRN Energy thing, that this has been increased.
So in TRM and Maheshwar, we have increased the provisioning, and basically in absolute terms, this has obviously decreased, and in percentage terms, it has increased.
Okay, got it. And my second question is, how much percentage of our book will get reset in this current year, and what will be the impact on NIMs? Will it get further dragged down this year?
So we have this policy of resetting in 3 years, and so maybe around 1/3 will be reset this year.
And will it be dragging down our NIMs further, or do we see that it will be at the same level because of the reset?
No, it appears that it will be at the same level.
Okay. And with AT&C losses narrowing down and the target of ARR and ACC gap to be zero in like another 3 to 4 years, how do we see that it will going to impact PFC's book? Do we see that the book size would decrease, and how much should it reduce because of all the narrowing down?
So with the financial health of the discounts improving, obviously the overall our portfolio assets will be on a better footing.
Okay, but do you see that some quantum that our book will reduce because of if say ACS and ARR gaps narrow down to zero?
No, but there is going to be addition in the infrastructure requirement for the power sector to grow, and additions will be there in transmission, distribution. So that we see this is a growing sector, and under Saubhagya, you know that all the households have been electrified. Now the consumption there will increase, the energy requirement will increase, and the requirement of expansion of the network will be required. And then the renewables energy is going to come in a big way, and evacuation from this renewable energy will also be required. So there will be a substantial capex requirement for transmission and then down below distribution also.
Okay. And my next question will be on the spread. So spread on RESS and LPS. So is it like sub 2.3, 2.4 because it is state guaranteed? What's the range of the spreads we have on RESS and LPS loan schemes?
So in both these we are going to this LPS we are going to get the state government guarantee. So obviously we give a lower interest rates to them, and our spreads will be lower in these cases.
In line with our
So is it like sub 2.3, 2.4 or sub 2? Any?
That we have to see. The overall we have around 2.5. So we have to see that spread.
Okay.
Our Director of Finance would like to add to this.
So this is in line with normal business operations, that as sir has said that we offer 25 basis point reduction in case of government guarantee. So only that concession has been given, since all these loans are backed by government guarantee.
Okay. And my last question would be on the spread on infra and EV sector that we are doing. So are we having higher spreads than renewable on this? On infra and renewable, on EV?
So these are the new areas which we are going to fund, and if it is a project within the energy transition area, then we can have a lower spread. But for other infrastructure projects, it will be slightly higher because the risk we perceive and the new areas which we are entering into.
Okay. Thank you so much. I'll join the team.
Thank you. The next question is from the line of Chintan Shah from ICICI Securities. Please go ahead.
Yeah, sir, congratulations on good set of numbers, and thank you for the opportunity. So, sir, I had one question largely on the yields front. So in terms of fixed and floating book, how much percentage of our book would be fixed and floating, or is it that it is entirely floating?
The majority of our loan book is floating in nature because, as indicated, the interest rates are reset after every 3 years.
Sure, sir. And so, sir, in terms of the foreign borrowings, on the borrowing side, so, sir, how would it be that mix? It is also largely floating, or it will be a mix of fixed and floating?
No, there we have mostly fixed rate borrowings. So that is above 70% would be fixed rate borrowings.
Okay. And so one thing you mentioned in the opening remarks that we have seen a reduction of 250 to 300, 165 to 300 bits decline in the yield. So that decline was during what period, if you could just mention? And the reason would be the competition, right?
So no, not exactly competition. At that time, since September 2020, we have reduced the interest rates to during up to December 22 by 165 to 300 basis points. So there was competition also, and during that time the interest rate regime was also lower. So we were able to borrow at a lower rate, and we passed on that benefit to our borrowers.
Sure, sir, got it. And so largely in terms of this hedging cost, I just wanted to understand from the accounting perspective. So the hedging cost for the foreign currency borrowings, that would be accounted under interest expense, or would that be a separate line item?
Our Director of Finance would reply to this question.
The hedging cost is forming part of the interest expense.
Okay, ma'am. I think that's it from my end. Okay, ma'am. Thank you. Thanks. Yeah.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference, please limit your questions to 2 per participants. Next question is from the line of Chintan Shah from JM Financial. Please go ahead.
Hi, sir. Thank you so much for the opportunity. So I just had one question. So this quarter, there was no dividend declared by a subsidiary REC, and we have a statutory mandate for the same. So how should we read this?
Could you repeat that?
Yeah, so REC our subsidiary REC did not declare any dividend this quarter, and there is a statutory mandate to do so. So I just wanted to understand, is there any particular reason? Is there any change or something that we should be aware of?
No, there is no requirement as it is. Statutory requirement is not there, but we are hopeful we'll get the dividend.
And if you see the last year also, along with the first quarter results, they have declared the final dividend.
Okay, so in Q1 we should expect 2 dividends. One would be the final one and the normal interim one that will declare. Is that right?
Able to comment on that.
Okay, sure, no problem. I got it. So that's it from me. Thank you.
Thank you.
Thank you. Next question is from the line of Puneet Srivastava from Daiwa Capital Markets. Please go ahead.
Yeah, good afternoon. So my first question is on these yields and the ratios that you have given this time for the full year. Can we please have the quarterly ratios as well? Because that will help us a lot to understand the quarterly movement.
Our Director of Finance. So we will share these numbers with you.
Okay, sir. And the other question was on the margin front. I mean, I believe you already have spoken about it, but we just wanted to understand, like, whether how the cost of funds are moving quarter to quarter, like whether we expect cost of funds to go up further from here or remain like stable. How do you expect the cost of funds to move from 7.5% levels?
So last quarter, if you see the interest rates have hardened, and going forward, I think we should be stabilizing at these values. And obviously, it depends on the market, and we are linked to the international market. So let us see what happens.
Actually, the question I was asking about the quarterly is because if you see the 9 months margins, net interest margins were reported at 3.37, and then for full year it is reported at 3.36. So there seems to be almost flat, but the numbers are showing that margins were under pressure. So that was the reason I was asking about the fourth quarter, because there seems to be some adjustment happening somewhere. Because 9 months to full year, the margins are showing flat numbers.
So there has been some reduction in the yield, but if you see the margins that we are able to maintain, I think Q4 margins were still around at 3.39%. So whatever additional numbers you require for the Q4, you may please let us know. We will provide you.
Sure, I got it. And just sorry, I can include one question. Would you have some kind of ROE target which you internally look at, and if you'd like to share that? Thank you.
So we do not have any targets as such.
Okay, thank you. That's all.
Thank you. The next question is from the line of Dhaval from DSP. Please go ahead.
Yeah, sir, just one question relating to the credit cost for next year. I mean, this year we saw some write back on a net basis. So next year, would it be safe to assume that the credit cost should be less than 20 basis points? I mean, given that there are still large projects under various stages of resolution.
So we will not able to say that because most these projects, as I had indicated, are under NCLT. So how much time they are lingering on for quite some time, and how we are able to resolve this. So we are not having any target with respect to that.
Understood. Okay. That's it, sir. Thanks.
Thank you. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Sir, thanks for the opportunity. Just wanted to understand on the infrastructure segment, like how are we looking at between, say, the public projects and private projects, and what was it sanctioned in FY23, which is yet to be disbursed in FY24, and what is the pipeline for sanctions for FY24?
So PFC's loan asset is mostly in the government sector, and our first reference for the infrastructure projects also will be to take up some government sector projects. However, we have funded electric vehicles, etc., which were in the private space. And as indicated, we have sanctioned loan for the ports, and there we had the disbursement of around 1,000 crores. And moving forward, we would these new type of projects, energy transition projects are there, which we will be taking up, like pumped storage schemes, And if this offshore wind comes up or green hydrogen projects come up, we will be taking up these projects.
Sure, sir.